Good afternoon, everyone, and welcome to the 17th episode of the Capital League Insight series of webinars. The topic for today's discussion is India's Moment. This is the title of The Economist magazine dated 13th May 2022. I would like to quote a couple of lines from the article. The Indian economy is being rewired and the opportunities are immense. If you take a step back, a novel confluence of forces stands to transform India's economy over the next decade, improving the lives of 1.4 billion people and changing the balance of power in Asia. Technological leaps, the energy transition, and geopolitical shifts are creating new opportunities and new tools to fix intractable problems. Quote ends. So articles like these prompt us to sit up and take note of the transformative changes happening around us. The various decadal trends like increase in women-to-men ratio, a sharp decline in fertility rate, financialization of savings, and massive transformation enabled by the various components of the tech stack like mass adoption of digital payments, access to free online education and other resources, and platforms are all signs of a transforming, maturing nation. The hinterland, which is now connected with the internet and the digital economy, is a sweeping development that is awakening a sleeping beast. Additionally, there are innumerable changes and reforms underway at a more fundamental level across the length and breadth of our country. So amidst all the gloom and doom scenarios playing out with the COVID-induced changes in our lives, the ripples from the Russia-Ukraine crisis, the scalloping inflation and Fed tightening, there is a ray of hope. India is uniquely positioned to benefit from the current disequilibrium in the world. And what looked like changes in the short term can be the very factors which can give the much needed push for tough reforms, which in turn can propel the Indian economy onto a higher growth trajectory. To gain insights into why India could be at the cusp of regaining its moment in history, and what are the challenges and headwinds likely to create opportunities and shape the outcomes for us, we are honored to have with us today one of the most illustrious and respected economists in the country with a unique voice, Dr. Ajit Ranade. Till recently, he was the Group Executive President and Chief Economist at Aditya Birla Group, an Indian multinational conglomerate. He is currently the Vice Chancellor of Gokhale Institute of Politics and Economics in Pune. Dr. Ranade is also the co-founder and trustee of the Association of Democratic Reforms. He has co-authored an award-winning book titled Rising to the China Challenge. Dr. Ranade is an alumnus of IIT Bombay and IIM Ahmedabad, and he's received his PhD in economics from Brown University. So I would like to thank Dr. Ranade for joining us. Let us see, he was a little delayed. Is he there, Dr. Ranade? I can't see you yet. So I think he will be joining us shortly in just a couple of minutes. So before we start the session, I would also like to mention that we shall have a 15-minute question and answer session towards the end. Request you all to please type your questions in the Q&A section at the bottom of your screen and address them to the panelists. So if you could use the time now to put out your questions in the Q&A section, that would be good use of our time. So hello everyone again. I've just spoken with Dr. Ranade and he's joining us in a minute. He's reached his office. Yeah, Dr. Ranade, are you there?
Yes, can you hear me?
Yes, I can hear you and see you very well. Thank you so much. So I have introduced the topic and I have introduced you, and I would now like to invite you to share your thoughts and insights with us.
Okay. So anyway, good afternoon to all of you, and sorry for the delay in starting. Uh, the the topic actually is India's moment, but I want to take a stock of the current context and maybe step back a little bit, talk a little bit about the geopolitical context, and then perhaps a little bit about the medium to longer term context. But before I do that, I would like to request that perhaps the best way of interaction or getting the most out of this session is to keep it participative and interactive. So I look forward to Rajul, our interaction, of course, and any questions or comments, feedback that we may have from our participants. So I guess, is that okay? Would that sound good?
Of course, yes.
Okay. So I think everybody's concerned about the immediate context, which clearly the number one topic on everybody's mind is inflation. And that's very, very immediate, I would say, concern. The reason being that it's a generalized inflation. Earlier, we thought it's only going to be commodities or mainly driven by oil. And some of it, of course, relates to the uncertainty due to the Ukraine war and so on. Then that went to other commodities, like, for example, in India, we're talking about steel and cement and construction material. But actually, it looks like it's a little bit generalized. It's not just commodity-specific inflation. What we saw some time ago, as you know, that the wholesale price index-based inflation, that is what we will usually call the producer price index, or what we could refer to as commodity price-led inflation.
The input,
that was indeed, yeah, input cost. That was indeed running at 14%, 14.5% for almost a year. But during that same time, the consumer price inflation was running at only 6%, maybe 5.5%. Clear gap of 10 percentage points. Very unusual, because usually WPI and CPI based inflation should somewhat converge, but this was very unusual. Of course, the CPI based inflation, even running at say 5.5 or 6, is actually at the upper band of the tolerance of the Reserve Bank of India. As you know, the Reserve Bank of India has this Monetary Policy Committee, MPC, whose mandate is to target inflation, and it's a flexible target. It's between 2 to 6%. So technically, if you're at 6 or slightly below 6, you're still within the target. But when you say flexible target of 2 to 6, the implicit understanding is that the median rate, which is 4%, is what we should expect, or we should really that's where the inflation rate should stabilize. But the fact is that it was 6% for almost 2 years, since early 2020. And the puzzle was, how come the MPC did not see it fit to do something about it? Because since 2018, almost for now 4 years, the stance of the Reserve Bank of India, or MPC, has been quite accommodative. That means ignoring inflationary signs, or being complacent about it, or thinking that it's not that of a threat or an issue, and therefore keeping interest rates very low, and also being very accommodative in terms of liquidity, more than 7 or 8 trillion rupees on a daily basis, right? So that was the situation for 4 years. So as I said, the number one issue right now is inflation. And suddenly, earlier this month, in the month of May, the first week, suddenly there was a abrupt, I would say, a U-turn, because just about 4 weeks ago, until 4 weeks ago, the language was that inflationary tendencies are there, but they are somewhat, manageable, if not benign. But we should be worried about growth. We should make sure that interest rates are accommodative or liquidity is ample. That was the language. People, by the way, there are professional RBI watchers who get paid for parsing every comma and every syllable,
Analyzing
right?
reading between the lines too.
Yeah, because it's their job to anticipate what RBI is going to do. And therefore, it was very surprising. Therefore, it was surprising that just abruptly, complete U-turn. Now the language is very hawkish. In one sweep, the RBI has taken out some 12% of the liquidity, almost 90,000 crores, just completely vanished, mopped out. And the subsequent interview by of the RBI governor says that no, we're going to hike interest rates quite a bit now. Be prepared for it, blah, blah, blah. So this was, I think this U-turn means that my reading is that there must have been some political signal, some pressure on RBI to say that we can't be, complacent about interest rates and monetary policy. So that's the immediate concern. And of course, related to that is whenever inflation is high, it does affect the sale. I'm just reading that the FMCG companies are feeling the heat. Even the sale of mobile handsets is down 30%, or there's a slowdown in many other industries. So that is one negative impact of high inflation.
All interest rate sensitive sectors where people purchase on EMIs.
Interest rate sensitive sectors, especially housing finance and retail finance. But that's how it's on the retail side. I don't think industrial investment, corporate investment, greenfield investment, new factory, building, I don't think that is if affected as badly, because clearly interest rates are not the number one factor which industrial investment or large scale corporate investment looks at. They look at the demand outlook.
Dr. Ranade, could you also throw some light on these corporate balance sheets? Because I believe how are they looking now, and what is their debt situation? Because over the last 3-4 years when interest rates were low, did they repay their debt, and how was it?
Yes. So I'm just basically just to finish this point about inflation. So if you just move aside, inflation is number one concern, not only because the retail people are affected by it, but also because from a corporate side, too high inflation means the purchasing, it gets affected in sales. People, there's a downgrade, there's a downscaling, or whatever you call it, down. The FMCG companies see that the people move from brands to non-brands. So there is that.
It's called shrinkflation.
Yeah, or shrinkflation, exactly. So that is inflation. But now you're asking, so what does on the other side, what the corporate sector looks like? That actually has been a good story. There's been a fair bit of, ever since ILFS episode of 2018, September, since then, I think there's been an instinctive deleveraging trend. That means to say that corporates have taken advantage of lower rates during the pandemic also. As you know, during the pandemic, we had a moratorium, interest moratorium. So I would imagine that the large corporates have actually deleveraged. So the debt equity ratios have improved, have become more, and then banking sector recoveries have been better. Write-offs, not recoveries, I would say write-offs so the NPA ratios were improving, but that was until I would say March 21. That means last year, 1 year ago. And partly it was because of moratorium. The NPA ratio is getting better. But now since then, now there's a concern that maybe the NPA ratio might worsen again. This is because of now the end of moratorium. And now we have an interest rate cycle which is moving in the other direction. But I think overall the corporate balance sheets are in better shape in terms of their leverage. But on the other hand, they're not, the reason they were able to deleverage is because they prefer to repay loans and they prefer to pay high dividend payout instead of putting that money into fresh investment. So the flip side of the corporate sector story is that if we are not seeing large-scale corporate investment, it means that's going to affect future growth. So we need to look out at for that. And as I said, the corporate investment is driven not by low interest rates. That's what the RBI wants to enable, but it's driven much more by demand outlook. If the demand outlook is good for growth of 7-8%, then you will automatically see corporate investments. We are seeing investments, of course, by the public sector. We are seeing investments in infrastructure. We're seeing investments in all like railways or ports, but we are not seeing as much investment by the private sector. The kind of flow we saw of let's say of companies, private equity or IPOs like the big ones last year, Nykaa and all, those were simply, I would say, change of ownership. The money which was flowing either to pay off loans, like in the case of Zomato, I think, or change of ownership. The promoters were encashing and the fresh IPO money was going into, it was not going into the company. Like 5,000 crores were raised by, say, Nykaa, but almost 4,500 crores went to just from the retail public to the promoters or whoever was exiting. So less than 200-300 crores went. But I mean, if the stock market story is a very different story. So if you're talking about the economy and corporate sector balance sheets, that's different. But if you look at the stock market story, it's been propped up by retail, domestic retail, and domestic DFIs, domestic financial institutions. And the retail story, of course, you would know better, is the stickiness of SIPs and the steady money that's coming in. It may also be due to the fact that the financial sector savings, that is financial savings of the country, are as a share of total savings are increasing, and therefore you will see more money coming into the capital markets. But therefore, I want to caution that don't conflate the stock market story with the story of the economy. I mean, this is well known in India. It's possible for the stock market to do very well and the economy to not do well. And the classic example of that was during the year of the pandemic, 2021, when the stock market actually went up, I think, 20%, I forget how much, whereas the economy shrunk by almost 10%.
So would you say that stock market is a lead indicator for the economy and it looks much more into the future than probably what the economic numbers tell us?
No, certainly. I mean, I don't want to, as I said, I'm not trying to say that it is completely divorced. It's not completely disassociated. But I just want to contemporaneously, if you look at the behavior of the stock market and the behavior of the economy contemporaneously, that is, in the similar time period, that can be contradictory. But of course, you're right that the stock market is a leading indicator. It reflects, as they say, GDP data is from 2 months ago, and the stock market index is from 2 years ago, or 2 years ahead, or 1 year ahead. Yeah. So the stock market is usually betting on anticipated earnings, and the GDP is reporting last quarter earnings. And to the extent that the stock market is mobilizing savings of the economy towards greenfield investment, towards fresh investment, new capacity, investment in new capacity, that certainly is telling you something about future economic growth. So in that sense, it's lead indicator. It's looking at the future scenario as anticipated by the stock market. But if the stock market is simply doing, as I said, portfolio reshuffle, money going from retail investors into promoters, or in the US context, in America, a huge number, so $1 trillion every year for the last 5-6 years, $1 trillion is going from company balance sheets, that is treasury, the company cash balances, to buy back shares. So in India, it's not allowed. In India, companies are not allowed to buy back shares as a tool for manipulating or managing stock prices. You can do it once, but you have to announce it to SEBI and you have to have a defined period. But in America, corporates routinely play with their own shares. In fact, for the last 5-6 years, as I said, $1 trillion has gone from the cash in the corporate balance sheets to buy back their own shares. And that has contributed to the stock market rally as well. There's a very high correlation between the Dow Jones index and the buyback activity.
Okay.
So as I said, your question was, is the stock market a lead indicator, an indicator of future economic growth? Yes, if that stock market mobilization of funds of savings is going predominantly towards greenfield and fresh investments, but not if it's going as a portfolio reshuffle or just simply for buyback.
Great.
So you want to
coming back to Indian economy. So what are some of the key drivers which you're looking at from a medium to long-term perspective, and how are they behaving in the short term? Of course, you said you would like
medium to short, longer-term drivers remain intact. The big drivers for the economy are demography, urbanization, formalization, and green economy and digital.
Right.
Just to repeat, basically, these are kind of, I would say, medium to long-term trends. You can call them mega trends for the Indian economy: urbanization, demography, formalization, then the green economy, and digital economy. All of these are drivers which are kind of they have kind of a relentless nature to it. They're impervious, especially if you look at these are, I would say, structural trends. They're impervious to business cycles or electoral cycles or fiscal cycles and so on. Urbanization is proceeding, as you know. We are still only about 33% urbanized. We are going to go up to 40, if not 50%. Formalization, we have seen that during demonetization. We have seen that during work from home. We have seen that during the lockdowns. That the shift from the economy going much more formal. The GST collections are increasing partly because the economy is becoming more and more formal from the informal sector. Then I mentioned demography, so I don't need to say that. The fact that the workforce remains young for the foreseeable future. That is not to deny that out of 35 states of India, more than 25 states are actually facing an aging phenomenon. Aging means that their total fertility rate has come down below 2.1 or 2. That means on average, every couple has barely 2 kids, which is just a replacement rate. And that's happening in 25 states of India. But the sheer momentum of the past means that population will continue to grow. And that means we'll have some 10 or 20 million people attaining the age of 18 every year. That's the demographic phenomenon. And that will continue. And that it has its own structural implications in terms of people entering the workforce, people wanting to work or save or consume or pay taxes or become potential investors of mutual funds, all that. So that is the demographic. Now, whether we will be able to find enough jobs for these people, whether there'll be enough skilling, whether there'll be enough adequate training, education, attainment. So we can park those questions at the time. But that's as I said, demography is a structural feature of the Indian economy. Urbanization, demography. Now we have the green economy. We have an ambition of 100,000 gigawatts of solar. We are on track. We are ahead of track. 75,000 whatever of wind. We are ahead. Ethanol blending. We are ahead. So anything to do with the green economy is just going to, anything that benefits from the green economy is going to keep moving ahead. Notwithstanding the fact that actually globally we are seeing the consumption of coal and oil is actually higher. So I'm even despite that, I think the green economy is where we're going to see growth momentum. And then finally, digital. It's not just UPI. It's everything is digital. Even SMEs, the micro, small, medium enterprises are migrating to cloud-based ERP solutions for tax filing, for even CRM, customer data management, or billing, or payroll accounts. Now there are solutions for even small firms for $99, for $200. SAP is not a word which can intimidate you. Anybody can have a customized off-the-shelf solution for SAP. That's what I mean by digitization. And then, of course, e-commerce and the rise of unicorns, like Zomato or delivery. All this tells me about the digital economy. So digital footprint is expanding. I think the current, I would say it's barely 10%, whereas for developed economies, it's probably 50%. So we have some ways to go. Even if you go from 10 to 20%, it's a doubling of the digital footprint. India's IT and software exports are $250 billion and growing. But that's not, when I say digital, I don't mean just that. I mean the whole business of how retail is shifting towards e-commerce, or how all kinds of services, whether they're entertainment or medical services, e-governance, education, edutech, is progressively moving towards retail. So that's also, so that those are the 4 or 5 I think long-term, medium to long-term mega trends which are likely to persist.
So with these mega trends, I mean, what kind of growth can we look at over the next 7-8 years? I mean, IMF and Indian government itself has revised its $5 trillion target to 2027 from 2025 earlier. So what is your opinion on that? I mean, are we doing enough to reach there in the next 5 years?
Actually, I believe IMF has revised it again back to 2026. So anyway, it doesn't matter whether it's 25 or 26, 27. We are going to get there because it's just a number. If we are a growing economy and we are at 3 trillion today, at some stage we're going to reach 5 trillion. Your question, I think, is about how fast are we growing. Yes. So the fast growth, the speed of growth is actually a feature of a structural feature. You can kind of accelerate growth by doing some fiscal and monetary policy, but you can't overheat the economy. So I think if you ask me what is the structural growth rate, which is kind of a sustainable without overheating, I think it's about 6.5% to 7. It's not 8% for various reasons. We can discuss that. And
could you please elaborate on that?
Well, it's like a motorcycle. It's got an engine, right? Even the best of the Bullet has got 350 cc. Or a Maruti car has an 800 or 1100 cc. So you can't run that car at 200 kilometers per hour. So I think that's the feature. If you want the Indian economy, the structural impediments, if I can call them that, is that human capital. If you look at the gross enrollment rate, that is what percentage of, first of all, how many percentage of the kids are going to school? I think we have 100%. How many are graduating from high school, say 12th standard? Of the 12th standard, how many are going into college? For countries in Scandinavia, Northern Europe, Canada, Korea, that percentage is 80, 90%, even Russia. For India, that number is barely 20%, not even 20%. Our aspiration is to go up to 20%, 20, 24%. That in turn affects what is, so today the higher value added in national income in GDP comes from the knowledge economy. Knowledge economy requires formation of human capital. Human capital formation requires education attainment. That requires college enrollment. I mean, we are not even going into things like quality of teaching, quality of the curriculum, how contemporary the curriculum is. Are we still teaching old curricula, or are we teaching some new stuff? So I think that is one example of why we are at about 6.5 to 7%. If our educational, if our human capital formation process, which is basically the education sector, if that sees substantial reform. Now we do have a new education policy, or a national education policy, which was rolled out in 2019, I think 2020, and that does a lot of reform. That gives a lot of autonomy and flexibility to the university system, to colleges, for designing their curriculum, for faculty salaries, for student fees, enrollment, opening new satellite campuses, collaboration with foreign universities. So it's a host of reform. That's just university system. You imagine the kind of reforms we need in the school system. We have 16 lakh schools in the country, of which 11 lakh schools are in the government sector, either municipal or state. So the bulk of the action is there. It's not one Ashoka University or one Jindal University which is going to move the needle. It's actually so I believe that's where the maximum bang for the buck, maximum gains from reforms will come from education. But until that, we have to live with 6.5%, and 7% will be good. My guess is 6.5 is something. We do have a bounce, the cat bounce, dead cat bounce, they call it. So just because in 2020-21 we were down -7%, so next year our growth is +9% or plus even 10%. That 10% is misleading because it's on a negative base. I think your question was about a sustainable pace.
Yes, yes, for
So
over
that
the
is
next
the
7-8 years.
Yeah, that is.
So China grew for a number of years at 14 to 15%, even 10, 12%. So how did they manage to do that, and why are things different here?
See, no, see, the Chinese story began in 1978 when Deng Xiaoping became, by the way, Deng Xiaoping, so there was the Mao era, then there was the Deng Xiaoping era, followed by, Hu Jintao and Jiang Zemin and so on. And then there's the Xi Jinping era.
Mm-hmm.
So the Deng Xiaoping era, which we call that the Chinese beginning of Chinese reforms, is amazing because Deng Xiaoping did not occupy any office. He was like Sonia Gandhi, you could say.
Mm-hmm.
He was not premier of China. He was not president of China. He was not the commander of the military. He was not the general secretary of the Communist Party. Of course, he held some positions, and yet he had the most influence on the economy. So anyway, due respect to Sonia Gandhi, I don't want to make any undue remarks, but basically it was economic reforms. I mean, they completely deregulated the labor market. They were able to take 300 million people from the rural areas to the urban areas. The special economic zones where foreign investment was given a red carpet welcome, and more importantly, all kinds of regulation which is applicable in the mainland economy was made completely irrelevant in the SEZs. Considerable amount of empowerment to the local governments, including the mayor of a city, who could sign binding agreements with foreign investors, something that a mayor of an Indian city cannot do. And the fact is that it was a growth-led, trade-led, export-led growth.
Mm-hmm.
And the West was only very happy to move its manufacturing locations to China. So China was knocking on the doors of WTO. So WTO was formed in 1995, and China was not allowed entry until 2001, and they were given a full status only, I think, in 2010, much later. Okay. But the Chinese export juggernaut was chugging along from the early 1980s, and that was so India cannot replicate that easily because first of all, we did not believe in export-led growth until 1991. Remember, they started in 1978. We started 13, 14 years later. Because until then, we had kind of some degree of export pessimism. We didn't believe that exports could be a source of dynamic growth. It's only, and then later in the late 1990s, in the .com era and the Y2K bug and all that, that's when we saw the success of IT companies. There was a small news item in the New York Times in 1993. They said there's some Indian company which is supposed to be growing very well. They've attained revenues of some $100 million. Some company called Infosys, but this is just going to peter out. Imagine $100 billion, and today they're all 10 billion. TCS is, I don't know, $15 billion company with a market cap of God knows 50, 60 billion. So that also happened around late 1990s. So India's spectacular success has been in IT and software and IT-enabled services, but not so much in manufacturing exports like China. So your question was, can we? I think no. I mean, it's because we have a very different system. We have the political system is different. The mahol, the context is also now changed. The world after Trump started deglobalizing a bit. There were instinctive protective barriers put up. Mr. Trump government put stiff import taxes on steel and aluminum and all that, not just from Russia, from the rest of the world. They slapped duties even for imports from Europe. So there was tit for tat action from Europe. There was the Chinese also started putting some taxes on imports from America. So that kind of, a little bit of anti-globalization sentiment is still persisting. So we are not in the same, now the world context has changed. And now the economies during the pandemic have become much more closed-minded about, because they, till today, I believe the Americans cannot cross over border into Canada. During the pandemic, the Canadian border was closed to everybody, including Americans. I mean, Americans used to just drive over to see Niagara Falls and come back. They're not allowed. So the pandemic has also contributed to some kind of closure of national borders, which also affects, I think, some of it affects international trade. So for India to replicate the Chinese trade story, the global trade has to really boom, and globalization has to be back in fashion, and open borders and low tariffs and low import duties. I don't see that coming very quickly.
But what about everyone looking at an alternate to China, the China plus one, what everyone is talking about? So does India have an opportunity there, at least in some of the
Yes. Absolutely. So there are, of course, opportunities for India, as I said. First of all, let me repeat that IT is a spectacular success story and continues to be a success story. $250 billion today, perhaps $500 billion in the next 5-6 years, 10 years. Then the other thing is about this China plus one. So because of the kind of skirmish that began with this Trump government, and then subsequently all these border clashes, not just with India, with Japan, with Philippines, with countries, even with America. So and then the fact that Americans are also putting sanctions, the arrest of the CFO of Huawei, in North America. So that means some of the Western companies are thinking that it's better to de-risk.
Right.
So rather than depend only on China-based manufacturing, there is a migration towards other locations as well. And that's where I think India has a potential to benefit from it. We have competition from Vietnam. We have competition from perhaps other countries. But that's one area where India can potentially benefit. Secondly, India's own conscious strategy of trying to reduce the dependence of too many Chinese imports. Right now, China's imports into India are about $70 billion, $60, $70 billion. So India is trying to reduce that. And that is again by promoting domestic manufacturing. One of the big incentive schemes that is on currently being offered is called PLI, Production Linked Incentives. It is across 13 sectors. And it is not supposed to be like import substitution. It is not like the closed economy and inward-looking policies of the 1960s. It's slightly different. So that may have some success. So of course, that's why I'm saying when I said 6.5%, 7%, it includes all these policies. If you want to break out from 6-7% into 10%, I believe human capital will be our biggest kind of impediment to crack. But of course, I think we are going to see a slightly higher scale of manufacturing, partly as PLI, partly as China plus one, partly also India is now much more open to the ideas of being part of global value chains. Earlier, we used to sign FTAs, free trade agreements, only under the condition that the trading countries have to at least add 40% value. So the value added norms were very stiff and very high. Now we are okay even if it's 2-3%, so long as there is, Indian companies can be part of value chain. We take pride in the fact that now iPhone 13, Apple, iPhone 13 is manufactured in Bangalore, but we don't mention that it's only 2 or 3% value addition but we are okay with that because first of all, it gives the world a signal that Apple wants to locate in India. Secondly, it does create some local employment. Thirdly, there is some diffusion of know-how and best practices. When an iconic company like Apple locates, some of the other companies who are vendors and suppliers, some of the best practices, management practices, technology practices, they also diffuse. So these are the intangible benefits. So I think some of that we are going to see.
So, Dr. Anand, in PLI, why do you think now it is a potentially winning formula compared to the Make in India, what government was promoting earlier? I mean, that never took off in a big way, really.
No, I think the Make in India was not very well articulated, whereas the PLI is now much better articulated. In the sense that PLIs are very well designed. This is the sector, these are the conditions, this is the time period for which it's applicable. This is the, you have to guarantee this, you're going to be paid an incentive if you exceed the production of this target, etc. Make in India was simply a slogan which said that try to locate your manufacturing activity in India, but I don't see PLI and Make in India as two different things. PLI is just giving more detail and more structure to Make in India. And incidentally, Make in India was never meant to be import substitution. It was supposed to be Make in India with global benchmark, quality benchmark. It was implicit, but never explicitly said. But now with PLI, I think it's a little more explicit. So as I said, PLI has been announced for 13 sectors, and there are some signs that especially in mobile handsets, India exported 42,000 crores worth of handsets. Just this last fiscal, 21-22, we exported 42,000 crores worth of mobile handsets.
And we were a net importer a few years ago.
Yeah.
Handsets. I mean, mostly I guess.
So is it 42,000 crores? It's 32,000, some 35,000 crores. It's a pretty significant number, and that's going to increase.
So, Dr. Anand, coming back to this China, very interestingly, I saw that you've co-authored the book Rising to the China Challenge, where you and other authors have presented a blueprint for national rejuvenation that will translate into the nation rising to the China challenge. So could you please share some highlights of that blueprint from your book?
So the rise of China in the world, so the reason we have seen this US and China skirmish, or kind of whatever, saber rattling, whatever you call it, is because not because it's only threatening economically. I think to me it is like a tech cold war. If you go to China, you won't be able to use YouTube or Gmail or Twitter or Facebook, or because it's all closed, it's all banned. It never was allowed.
Yes.
So it is as if you have to either be in the US camp or in the China camp. So it's kind of a tech cold war. So the Chinese challenge to the Western world is, how are we going to, it's not just warfare like the Cold War with the Russian, USSR or Russians. It's about cyber security, cyber attacks. So in this book, we talk about the fact that India also, the trigger for the book was what happened in Galwan in Ladakh in June 2020. And we said that India must rise to the China challenge in terms of trying to reduce its dependence on Chinese imports. And therefore, much of the agenda is domestic. It's not like you are going to go and attack China or do something. We did things like we banned the apps, or we restricted the amount of money that was coming in from China in terms of capital investments, or even ECBs, commercial loans. But really, most of the agenda is about domestic reform. So rising to the China challenge is about what you said earlier, 8% growth. It's about PLI is one example, but the book has lots and lots of details across different sectors, very specific, specialty chemicals or plastics, or even APIs, that is advanced pharmaceutical ingredients. Things like penicillin and paracetamol, we are importing to China in a very big way. So trying to reduce, it can't happen overnight. It will take 5 to 10 years, but we have to start. India, penicillin was invented, I guess, in the 40s or something, 30s. And the first factory came up in India in 1950s, Hindustan Antibiotics in Pune. And guess what? I think it's almost shut down. So we did, it's not as if we don't have the capability. The Chinese costs have just meant that many Indian companies decide to shut down. So we are focusing on that and saying, and we also, I must say that the book also contains a description about China's vulnerability. People think that China is just an unstoppable juggernaut. but it's not. There are a lot of vulnerabilities and constraints that the Chinese nation and the economy faces itself. Number one is aging, and number two is related to aging, which is declining productivity, the decline in the size of labor force, the rising labor costs, the pollution-induced movement away from dirty industries to so-called cleaner industries. Then this hostility with neighbors, and then of course hostility between government or the Chinese Communist Party and their own private sector, whether it's Alibaba or Tencent, and the Evergrande episode. So these are all showing the social media, the pressure of social media within China, like Weibo. So don't think that the Chinese are also, they have their own constraints also. So when we say rising to the China challenge, we must focus on what playing to our strengths and trying to focus on the domestic growth agenda, and also not forget the Chinese vulnerabilities.
That's interesting. So, Dr. Ranade, coming back to India, now you said that at least public expenditure is happening. The government is investing on infrastructure. So could you please elaborate what kind of projects and size, and is that enough to kickstart the virtuous cycle of investment in the country?
You mean India? Yeah. There's the Gati Shakti, the asset monetization program, which is supposed to result in some 6 lakh crores of GDP. And there is, of course, the ongoing roadway development program. Idea is to reach 9% of GDP as the expenditure on infrastructure. Total capital expenditure should be 9% of GDP on infrastructure. We are at around 4.5 or 5%. So steadily we are trying to increase that. And infrastructure spending results in creation of infrastructure assets, which are they live for multiple generations. They're financed by taxes or bonds of today, but they live for 50 years, if they're properly built. That means they actually benefit 2 or 3 generations of Indians, 2 or 3 generations of taxpayers. That's so what might seem as if we are increasing the fiscal deficit today, or we are increasing the debt to GDP ratio today, but actually it is benefiting future growth. So I think I'm happy to note that the government also seems to be thinking in that direction. Although I'm not saying that fiscal consolidation or fiscal discipline is not important. Of course, it's important. But when it comes to spending on infrastructure, we need to weigh the benefits of the fact that they go to multiple generations, including the future generations, when we plan on fiscal expansion or fiscal spending today. So that's why we are seeing deficit planning is now at 6.5%, which hopefully contains the biggest increase came from infra spending. But as I said, this year is a challenging year. The Ukraine war, the residual effects of the pandemic, the 4th wave, the fact that high inflation caused by supply disruptions or oil. So that means this year, 2022-23 is going to be a bit of a challenge. But then we should see us going back to a little more sustainable medium-term trajectory.
So, like you are saying, this year is a challenge, and it's mostly inflation, which is the end result of whatever has happened, whether it is, China's zero tolerance policy for COVID. They've shut down cities. There is a supply constraint. Similarly, UK, Russia, a lot of what they were exporting, all those prices have gone up. And okay, RBI is doing its bit, like you said, by tightening the monetary policy. So what else is the India's policy response to control inflation?
No, inflation can only have three ways of tackling: monetary policy, fiscal policy, and administrative policy. Administrative policy is like an export ban. They said you can't export wheat, you put export duties on steel. So those are examples of administrative. They will put some stock limits, you can't hold food grain, or they might actually impose some administrative controls on how many cement bags can be, whatever. So and fiscal example is where the government is giving away free food grain to keep food inflation low. So the ration shops, they're giving 5 kilos of grain, either wheat or rice, and 1 kilo of pulses to every person per month for nearly 80 crore people, I believe. That's been going on from May 2020. We are already in May 2022. So 2 years we have been doing it, and it's gone extended till September. It might go up to March next year. That's an example where there is a fiscal spending to keep in food inflation low. Monetary policy, of course, we discussed earlier. So these are the multiple ways.
So when government has, let's say, reduced excise duty in petrol and diesel and
Yes,
stopping
that's exactly, yes.
ports, so is that going to impact the fiscal deficit further? And
So that's
and
an
the government
example.
also has a huge borrowing program this year, and interest rates are going up. So how do you see that panning
So
out?
that's an example of another fiscal measure. So excise cuts on petrol and diesel is essentially to ensure that keep the inflation low, and that means there's fiscal cost. When you increase fiscal spending, either you increase spending or you reduce taxes, the same thing, and that will increase the fiscal deficit, and that means there's more borrowing. That means there's higher pressure on interest rates, and higher interest rates means higher fiscal borrowing. So it's a very tricky balancing. It's not easy. I'm not envying the government. It's not easy, but as I said, this year is going to be difficult.
Okay. I will ask one last question and then we'll look at audience questions. I can see a couple out there. So Dr. Ranade, in one of your lectures last year, you had talked about huge global growth at 5-6%, both from US and Europe for the next few years, and how India would benefit from it. But obviously now 1 year later, we are talking about a global recession. So what is your prediction now? I mean, in that kind of a global scenario, will that also last, or will India be an outlier when we are talking of 6.5% growth?
Yeah, that I think, I don't know, that talk probably was when I did, we did have 5% growth in the US, and we did have 3-4% growth in Europe, which by their own historical standards is fantastic growth. 5% growth in USA is like 50% growth in India, because we are 1/10 their size. And that was before Ukraine. And that was before the sort of third or fourth wave. So I thought that because we are bouncing back from the pandemic, and because there was all this pent up demand, and because there was all this fiscal expansion, it would mean that India can benefit from exports. And indeed, by the way, 2020, I guess 21, 22, right? Our exports went up to 440 or $430 billion. So we had a 37 or 38% increase in exports. So we did benefit, but unfortunately, it's now all been interrupted by Ukraine war. People thought first of all, nobody expected it. I mean, even though now they say, experts say that we saw it coming from 2008. Nobody expected it. Secondly, people thought it would be a short war, but it's going on and on and on and on and on. That is making, there's so many other domino effect, like the formation of Quad now, which is India, Australia, Japan, USA, and opposing that is the Russia-China nexus. If you look at the Davos discussion, it's all about inflation, and so this is Ukraine. I mean, it's a small country, but it is now affecting world sentiment, including investor sentiment. Now, even in the US, they are talking about possible recession. The biggest indicator, the lead indicator, is housing sales. They are down by 50%, the latest data. So how did that happen? I think it's Ukraine. But we can't blame everything there. Maybe there were some inbuilt vulnerabilities. So I thought that we should see 1 or 2 years of good growth. But that's again now, as I said, it's going to be difficult. But India is largely domestically driven. So if we can, for example, sustain our exports at $400 billion next year, that is 22-23, keep our IT and software exports at $250 or $270 billion, and infrastructure spending, strong spending, we should be okay. I mean, we can be better, but we should be okay. 3, 4, 4, 4,
so
5%.
that will make India one of the fastest growing major economies in the world.
That anyway is acknowledged by even the World Bank or IMF. Yeah, that's well known.
Yes, and that should filter down into corporate profits, the cycle turning, and ideally stock markets may get worse before they get better, but hopefully it will just provide an opportunity for next few years for long-term investors to compound their wealth. There is, let's look at an audience question. I'm reading it out. No doubt, it says PLI is a great stimulator and incentive for Atmanirbhar. It appears that only high-end manufacturers can think of. The threshold limit for investments appear too high for MSME to take advantage. How MSME or who are the majority which can take advantage?
Yeah, that's a good question. Actually, the PLI scheme is meant to be, it's not an MSME scheme. So we should be careful not to interpret it as support to SOP. It is basically to support scale by the very nature, by the very when you say production linked incentive, PLI, means higher the production, higher will be the incentive. So by definition, it's about scale. We want large scale manufacturing to happen in India. And if you achieve that level of scale, that target, and if you exceed that, we'll give you incentive payment. So it's not supposed to be for MSMEs. I mean, that's my understanding. And of course, the MSMEs play a very important role in the economy. They provide 40% of output in manufacturing, 40-45% of contribution to exports, 40-45% of contribution to employment generation. But that is a different challenge. I mean, PLI, I don't think is designed for that. Hopefully, the companies which have signed up for PLI, their vendors will be MSMEs, and they will indirectly benefit.
Right. There's a question on gold. What is your view on gold? Because if you see, dollar has been appreciating, dollar basket against other basket of currencies, and cryptocurrency has been falling, but gold is not going anywhere. So what is your view?
I think because we have a strong dollar, it would mean gold will remain flat. I don't see dollar strengthening and gold strengthening at the same time. So strong dollar means the gold will remain flat. It may not go down because it's slightly recessionary environment. Gold usually is a safe haven, but with a strong dollar, gold will remain flattish, I think.
So that gives way to the next question. What is your view on currency? And do you think dollar is going to remain strong? And what is going to happen to the rupee?
Dollar will remain strong. Rupee at 77, 78. Rupee is difficult to say. If our exports do better, like I said, last year our exports were $424-30 billion. If we continue that pace, then hopefully the currency will not depreciate to 80. But if we have high inflation and bad export performance and lower FDI coming into India, then we have to be ready with the rupee exchange rate at 80, 81. Otherwise, it will stay here, 78, 77.
So do you see the RBI intervening?
Yes.
More strongly? I mean, I think it's already doing some.
Yeah. RBI already has pumped in $40-50 billion. So that they will do. Because we can't afford the rupee to go to 81.
Plus also, I think that feeds into inflation, I mean, indirectly through imports.
Exactly. Inflation, it also means that it causes dollar flight, it causes stock market nervousness, all kinds of things.
Okay, there is a question on, I think, related to climate change. It says impact of climate-related shocks on inflation and growth, like heat wave, resulted in 5% drop in wheat production, leading to ban on exports of wheat. So do you think that could have a multiplier effect going forward?
Export of beef, did they say? Export of what?
Export of wheat. I mean,
wheat, yeah.
The thing is that because of the heat wave, wheat production dropped, and that is why we had to ban exports of wheat. Like earlier in the initial days of the war, we thought that we could gain by exporting wheat, and now they've banned exports of wheat.
Yeah, so climate risk is a longer term risk for everybody, not just India. So if you're going, for example, if you're investing in real estate and you're taking a housing loan, let's say, but you think that you're going to repay the loan in next 30 years. But what if your house is near the coastal areas, like in Mumbai, sea facing view? 30 years, do you know what's going to happen? What if there's a rise of 1 or 2 centimeters of sea level? But nobody thinks that way, right? We just think 30 years, nothing will happen. So climate risk is, I think we don't have enough time today, but that's an overarching risk for the entire global economy, and especially India is vulnerable to it. We have a large coastline. We have a large dependence on agriculture, which can get affected by weather patterns. and the rise of sea levels. So yeah, that's true. I agree that it's a big mega risk which affects everybody. Now, how to relate it to stocks and companies, I'm not,
Sure. So
yeah.
what is your view on real estate? Let's talk about real estate.
See, I think in a country like India, where the land-man ratio is adverse, you can't really go wrong if you take a longer-term view. You can't go wrong because I told you one of the mega trends is urbanization,
Right.
and there's a huge shortage of some 20 million shortage of homes, and there is a adverse land-man ratio. You can't, and housing finance as a percentage of total loans is so small. You can't go wrong on real estate. But sometimes it is micro market. In this pin code, market will be tight right adjacent to it. So there are a lot of local factors at play. Encroachment, hutment, slum dwellers, road construction, metro coming in. So it's very
localized in that sense.
Yeah, you can't generalize. My view is about generally that if I look at urbanization, if I look at the ratio of housing finance to total loans, and if I look at shortage of official shortage of homes, all that tells me a positive story. But when it comes down to investment, then you have to choose there's a lot of local factors.
So Dr. Ranade, our 1 hour is up. Would you have any closing remarks before we end the session?
No, India is always an exciting economy, and there's always things going on. Just look back at what happened in the last 30 years. We have 4 times or 5 times bigger. Per capita income is like, I don't know, 20 times bigger, or 15 times bigger. And the labor force is much larger. Sector by sector, there are stories of outstanding achievements, UPI, digital payments, Chandrayaan, but at the same time, you can't forget that large sections of society are facing, if not outright poverty, near poverty-like conditions, health and hunger. So India is always a very fascinating, and it's a country of contrasts. And we need to be worried about inequality, I think, but our government is committed to addressing that. We see that we have a stable government, and that's one plus point. Democrat. I don't see, for example, something that happened in Sri Lanka, which is more out of, or in Pakistan currently, the political turmoil.
Right.
I don't see that happening in India. But we can't be, we can't be complacent about the challenges we have, especially what I told you. Just, there are short-term challenges.
Right. So thanks a lot, Dr. Ranade, for your time and for an amazingly enlightening session. I'm sure everybody found it very topical and refreshing. And I would like to thank everyone for your time on a Saturday afternoon. Thank you, Dr. Ranade.
Thank you. Thank you. Thank you for having me. Thank you.
It's all our pleasure and our honor. And now may I request everyone to take 30 seconds to fill out the feedback form as you exit the webinar. Thank you all once again and have a great week. Bye.
Thank you. Thank you.
Bye.